Hello and welcome to this weekly market recap for the week ending Wednesday, January 21st, 2026. It's been a rough week, a little bit up and down for the market, but still, I think overall, we've done pretty well. For those of you that are new to the show, my name, Tom Bowley. I'm Chief Market Strategist at earningsbeats.com. It's always a pleasure to be on here with you all. Special thanks to Stockcharts for giving us some time here to go over the market. Really, this past week, first of all, we had a holiday on Monday, so we had Martin Luther King Day. So it was a shortened week, long weekend. Not a whole lot of economic reports out this week. Earnings season beginning to kick in. We've seen a lot of banks report so far. And yesterday, a big report came out in the form of Netflix. So Netflix reported they were down today, but they did rally off an earlier gap down, and they tested a key support. We'll look at that Netflix chart a little bit later in the show. A lot of rotation. We had news that our European allies were going to be hit with more tariffs on Tuesday. The market took a big drop at the opening bell. It was one of the worst days we've seen in a while in U.S. stocks. But then on Wednesday, earlier today, we had President Trump say that he was backing down on those tariffs, and the market rallied. But through it all, really what I try to do is block out the noise and really focus on what's going on in the market technically and where the money's rotating. That to me is what's really important, because it's telling us where those big Wall Street firms are putting their money, and wherever they're putting their money, that's generally going to be where I want to put mine. And so not a whole lot has changed underneath the surface of the market, but we're going to go over all that, take a look at some of the charts that I think are really key right now, and take a look at where we might be headed for the balance of January. So let's start off with how we've done over the last week, looking at the major indices, and we will start with transportation stocks, which led over the course of the last week, gaining almost 2%. We had the small cap Russell 2000 up 1.75%. S&P 400 mid caps up about 1.25%. And that's about where the strength ended. Then you can see the Dow Jones losing fractionally, NASDAQ 100 down about 0.5%, and the S&P 500 down 0.75%. So it was kind of a little give and take. Some areas took, some areas gave, and really not a whole lot changed other than the rotation. So the overall indices didn't change a lot, but that rotation, in my opinion, continues to be a problem. And we'll talk about that more throughout the show. Energy led last week, energy gaining 1.44% for the week. Then we had industrials, materials, real estate, consumer staples, and healthcare. Those were your leaders. Not a whole lot of aggressiveness in those six groups that were leading last week and moving higher. A lot more value, a lot of rotation. So what wasn't doing well last week? Well, technology dropping, consumer discretionary dropping, financials, communication services. These are not the kind of under the surface signals that we want to see when we're expecting the market to move back to all-time highs. We want money rotating into risk-on areas of the market. Just not really happening at this point. As we look at the S&P 500, you can see we've been going sideways. The action on Tuesday with that gap down, there were a couple of things of note there. I think number one, we lost the 50-day moving average, but we've done that recently in the recent past. It's been more of this sideways consolidation more than a steady uptrend or a downtrend. It's mostly just been sideways. We closed today, I think maybe 30 points on the S&P 500 above where we closed at the end of the year. So far in January, we have not really seen much headway to the upside. And what headway we did see earlier in the month reversed. And so we've seen the market come back down. That can be a problem. And I'll talk about that in just a couple minutes as well. But I think, again, for me, the takeaway, first of all, and I've mentioned this in the past, the absolute worst day for the stock market since 1950 has been the day that follows option expiration Friday. So you're either looking at, generally, you're looking at the following Monday. But of course, Monday was Martin Luther King Day, so the market was closed. So it was Tuesday, and that was the day we had the big drop. This is not unusual. Only 37% of the days that follow option expiration Friday, monthly option expiration Friday, only 37% of those days have been higher since 1950. 63% have been lower. So that's a pretty hefty shift from the norm. If you follow the market historically, like I have, or have just listened to my shows, then you probably know that since 1950, 53% of the days have been higher, 47 have been lower. So when you have a day like this every month, there's one day a month for the last 76 years, and that day is produced down days 63% of the time, that's probably statistically relevant. And it's worth knowing, especially as a trader. It doesn't really matter that much as a long-term investor, but if you're a trader, you need to know when these days are coming up because the tendency is to see more weakness than we normally would see. And that was the case again on Tuesday. Anyhow, we did bounce back today, did not recapture the gap. So we still got a gap to fill. We've still got a gap to clear. We've still got, in most cases, the 20-day moving average that we've got to clear. We moved back down below it. Tuesday, we moved back up and we tested it, but we haven't been able to close back above it just yet. So we still got that task out there, maybe for later this week. Moving on to the NASDAQ 100, very similar gap down below the moving averages and then moving back up, testing that 20-day moving average from underneath, but still below it. So if you're somebody that maybe thinks that Tuesday's action was bearish and we're starting to roll over, moving back up and testing that 20-day moving average could be a short-term top if, in fact, we are rolling over. So something to watch is whether or not we can get back through those 20-day moving averages on our major indices. As I looked across all of the industry groups for the last week, what I found interesting, and this is a chart list that we keep at Earnings Beats, where we've got every industry group in one chart list relative to the S&P 500. So I can just look at this chart list and quickly see what the best industry group is and what the worst industry group is and has been, in this case, over the last week, because that's the time frame that I've selected on this chart list. And this is a summary list. All features at Stockcharts, really cool stuff. But if you look at what was leading or what has been leading over the last week, the way I organize this is all of the industrial industry groups, everything that falls under the industrials sector umbrella, all is numbered with a 4. Let me just sort this in number order so you can see. All of my 001s are technology, and then I've got numbers which identify individual industry groups within technology. And then I go to 002, which is discretionary, 003, which is communication services right here, 004, industrials, 5, financials, and so on. So they all have their number. Every sector has their number. So when we're looking at the gains, and I can quickly just kind of look to see which sectors have industry groups that are showing strength. And when I look at this, I see industrials, I see energy, couple materials, industrials, staples, energy, materials, energy, industrials, real estate, another real estate. There are a couple of XLY, consumer discretionary, and a couple XLK, technology in here. But for the most part, what we are seeing is the same thing I just showed you with the sector performance just a little bit ago, where you can see all of these various value-oriented areas of the market as opposed to growth-oriented areas. And that's what I'm seeing on this list. And if we flip this and we look at what has not been working, now we're going to see a lot more XLY, XLK, 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 XLY, XLY, a couple XLFs, a few XLFs. There's an XLC, another XLC. All the aggressive groups are at the bottom. So we can look at this and say, sure, the market, last week didn't do a whole lot, but underneath the surface, the rotation continues away from some of the aggressive areas, most of the aggressive areas. Semiconductors have been an exception, at least most of the semiconductors. The problem is some of the larger market cap semiconductors like NVIDIA and Broadcom, AVGO. Those are a couple that are weighted pretty heavily in the S&P 500 and in the NASDAQ 100, and they're not keeping pace with many of the mid-tier semiconductor companies. So that's why, even though semiconductors have been somewhat strong and have been, I would say, resilient, and many of them unaffected by the shift away from growth, some of the bigger names have been having some issues. They're moving to 52-week lows relative to their peers, and that's what's been holding the overall market back. So I don't like, I mean, I like the shift in the sense of if you're trading the small cap Russell 2000 or the mid cap S&P 400 mid cap index, this is good news. And that's why we've been seeing outperformance in those areas. But if you're looking at the S&P 500, and you're looking at the NASDAQ 100, which are really driven by these large cap, many billion, hundreds of billions, or even $1 trillion market cap companies, that's when we're, talking about having some a little bit more issues in the market. Let's talk about Netflix. So Netflix reported and had a big move down. I'm going to just show you a 1-year chart first. We'll come back to this chart in just a second. But you can see Netflix for the last 6-7 months has been downtrending. If we pull up a different chart showing you relative strength, look at Netflix really for like the last 8 or 9 months. Its relative strength versus the internet group has been going down. It's another one of these large cap stocks that has really been weighing on the S&P 500 and on the NASDAQ 100. They came out with their earnings, at least bottom line, not that bad, but there's still a lot of questions going forward about the business. We did see a gap down. However, good news is that we gapped down to a key support level that we saw back in April and also over a year ago, which I'll show you in just a second. And look at that hollow candle. So on very, very heavy volume, we were able to bounce back on Netflix from a key support level. And I think that's pretty good news for Netflix, at least for now. That's all you can ask for on this gap down, was to hold support. And we did that at least initially. Now I want to go back and I want to show you this 3-year chart on Netflix, because this double bottom that I just pointed out at about $82, if you go back just over a year ago, right before earnings came out in January of 2025, Netflix was sitting right at about 82 then as well. So this is a really big area of support. I would expect Netflix to bounce off of it. If it doesn't, that really shows considerable weakness there. But so far, so good on Netflix. Again, if that can hold, that would be one more stock that could help us as we move forward. All right. Some of the themes I've been talking about and some of them that I'm seeing in 2026, I want to just emphasize. This is a chart of the small cap IWM. It's an ETF that tracks the Russell 2000, and it's plotted against the SPDR, the SPY, which is an ETF that tracks the S&P 500. So what this does is it just tells us how small caps are performing relative to large caps. Look at the start of 2026. I mean, I don't know if there is one chart that could be clearer as to what has been going on so far in 2026, but money is rotating away from the large caps, many large cap growth names, more into value and more into small caps. So this is one chart I think clearly that illustrates that right now. The other chart that I think clearly illustrates the rotation away from growth and into value is this IWF chart versus the IWD. So this is the Russell 1000 growth. So when you think about the Russell, sometimes you think small caps because of the Russell 2000. It's actually a Russell 3000 index, and 1000 is the largest 1000 of the 3000. So you're talking about names that are much, much more, much bigger than what you're going to see in the Russell 2000. So among these large cap names and looking at growth versus value, it's pretty clear money is rotating away from growth in a big way, and it's only accelerating so far in 2026. So when I looked at the S&P 500 earlier and I said we're up 30 points so far from the end of the year, that is not telling us the whole picture. You have to understand that even though overall we're kind of treading water in the S&P 500, I believe the big Wall Street firms are rotating out of many of the growth areas and into value. And if we were looking at a great economy ahead or lower interest rates and growing earnings, growth stocks should be leading, and they're not. And if for no other reason, that should maybe have you scratching your head a little bit as to whether or not you should trust what's going on in the market right now. The other thing I wanted to talk about a little bit here is the IWM versus the QQQ. This is a intraday chart that I like to follow. So it's a user-defined index that we use at Earnings Beats. We communicate with our members in our weekly market report every week. Money is clearly rotating on an intraday basis. Also, if we include gaps, it's rotating. And down here on the bottom, you can see the IWM going up. But here's the IWM relative to the QQQ, which is the NASDAQ 100. Money is rotating big time away from those large cap tech names and into small caps. Another chart that I like to follow on an intraday basis is the QQQ versus a spider, with the QQQ being recognized as the more growth-oriented index. They both have a lot of growth stocks. QQQ is high, there's more representation on the QQQ from growth, large cap growth, than there is on the spider. And you can see that has now been going down for several months. And you can see just recently it went to a multi-year low. I don't think that's good news for the market. And then if we include gaps, you can see that the weakness has been pretty strong for the last 2 or 3 months, and we're down near a 3-month low. So I don't like what's going on here. And then finally, if we throw in the XLY, XLP, discretionary versus staples, we are right now at we're at the lowest level on an intraday basis of this relationship, XLY to XLP. We're at the lowest level since back in late April. We are almost all the way back to that March, well, earlier low in April, probably middle part of April. You can see that low right here, which was probably about 91. We just got down to about 92.5. And then we bounced up today a little bit. I did update these through today's close, so we had up-to-date information. Now, why is this important? Why should we be worried about money rotating away from discretionary? Well, again, if economic growth is staring us in the face down the road and rates are going to come down and everything's going to be hunky-dory, why is money rotating away from discretionary and into staples? Those are questions that we need to be asking ourselves. And do we want to be in the market and take the risk of what could potentially be a more significant downtrend ahead? Look at what happened last year, going into the early part of 2025. In this ratio, we started rolling over, even including gaps, in January, and then we finally topped in February on the S&P 500. And then when that started rolling over, everything just tumbled to the downside. Right now, we got very similar kind of a setup where we've seen the intraday going down for 3 or 4 months now, clearly rotation away from discretionary. If we include the gaps, we just hit about a 4-month low just yesterday or late last week. And at the same time, the S&P 500 is again trying to put in new highs, but now possibly starting to roll over. This is something that we all need to kind of keep an eye on as we move forward. All right. For those of you that are new to Earnings Beats, go over to our website, earningsbeats.com. You can sign up for a free 30-day no-cost trial. You have to provide a credit card, but we will let you know prior to your expiration that you are going to expire and you're going to get charged if you either don't cancel or renew. And we're going to give you a great annual membership renewal offer at that time. Check us out. I'm telling you, probably the next 30 days are going to be extremely important on whether or not this is going to be just sideways consolidation or whether we could be looking at something a little bit more significant to the downside. So this would be a great time to check us out for that 30-day trial. Also, if you want a free newsletter, we do offer that. Comes out Monday and Wednesday. And when we say newsletter, I throw that word around a little loosely. It's a chart with 2 paragraphs. Very easy, quick read. Probably on Monday and Wednesday, you take 2 or 3 minutes and you'll be through it. It just gives you an opportunity to look at some of the things that we feel are important in the market, whether it be earnings gaps, relative strength, volume, but you can check that out for free. And then I also want to mention that on Saturday of this week, starting at 10 a.m. Eastern, we are having a January Effect webinar that is going to be live streamed. It is completely free, but you do need to register. So click on this link for the January effect. It'll bring you to this page where you can just sign up with your name, email address, hit that submit button, save your seat for the event. January gives us a lot of information about what we should expect for the rest of the year. The stock market doesn't just randomly go up or down, in my opinion. I think the stock market, especially Wall Street, the big firms, are planning for the market to either go up or down. And I think what we see in January a lot of times does give us a really good clue about the balance of the year. And so, what I'm going to do on Saturdays, I'm going to go over all that history with you. You can take the information and toss it out your window if you don't believe it. But I'm telling you, there's a lot of positive correlation with what we see in January and what we see over the balance of the year. And we already have gone through this October 28th to January 18th period, which was not very good. So January could possibly just add on to some of the many worries that we already have, that I already have about the market in 2026. So mark your calendar, make sure you come in and join us on Saturday. If you're on your mobile device, you can simply scan the QR code on your screen and sign up through your mobile device, trying to make it as easy as possible. And if you register, and this is really important, if you register and for whatever reason you can't attend live, you get a copy of the recording. So we want to make sure that you check this out and then go from there. And we'll see how we finish out January. All right, a couple more things to wrap up, or right before we wrap up. I did want to mention we have 2 chart lists I don't think I talk enough about. We do a lot of research for members at Earnings Beats. We have probably 20 chart lists that at any given point in time, our members can download into a Stockcharts account. If you have a Stockcharts account and it's extra or pro membership level, both of those would work in terms of downloading all of our chart lists. So you can take all of our research and put it into your account at Stockcharts, which I think is just amazing. But anyhow, these 2 particular chart lists really focus on momentum. So I do a chart list, which I call Leading Stocks and Leading Industries chart list. A lot of times it'll focus on areas that have been strong for a long time, like semiconductors. But it also starts to focus on groups as they begin to show strength, like pharmas have recently, or non-ferrous metals, which have been picking up, industrial suppliers, electrical components have regained some strength in the technology area. So what I'm doing is looking for relative strength winners in these different industry groups, and we put them all on one list. So you literally can go through. Over the last week, these stocks on this list have gained as high as 41%. You can see a lot of big winners on this list. And then the other chart list I want to tell you about is one of the guys that works for me at Earnings Beats. One of our team players is Matt Townsend. He's got a list that he keeps track of. It's 20 stocks, and many of his just stay on the list week to week. It's always 20 stocks. And he tends to go with the areas of the market that have been strong for an extended period of time, as opposed to just recently. So areas like semiconductors, very, very heavily represented. You can see a number of semiconductors on this list. So it's not meant to be well diversified. It's meant to give you some of the best stocks in the best market areas. All right, that is it for me for this week. I appreciate everybody tuning in. Come join me on Saturday. It's a free event. We try to do so much to give back to the community. This is simply our latest. So join us for this live stream on Saturday morning at 10 a.m. Go to earningsbeats.com. Make sure that you click on that January effect logo. Yep, that's me in one of my hats. That's not exactly one of the hats I normally wear, but I thought it was kind of funny. Anyway, come on over and join us on Saturday morning. We'd love to have you. And while you're at it, click that like button and subscribe to the Stock Charts channel. Have a great rest of your week, everybody. And let's see how this January market finishes out. Have a great week. Happy trading.